Let's bring in Jason Helfstein. He's head of internet research at Oppenheimer. Jason, it's great to see you. And the only thing I'd say about Netflix is it now feels like such a consensus long as it was almost a consensus sell back at its recent lows.
I mean, that's interesting. If you actually look from a Wall Street analyst standpoint, it's only 65% buy rated. So, I mean, honestly, we're a little surprised by the move today, especially since they didn't formally announce a price increase for the standard tier. It's obviously not as much of consensus long as you would have thought, just given the action today.
That's a great point. So only 65%, positive in the analyst community, or strong buy, I guess we would say. Also that they didn't come out with that change that you were describing. So what is it that has people so excited? Is it really this 2-hour engagement figure?
I wouldn't say it's that. I mean, there was plenty of data before the print. We tracked the Nielsen top 10, and we knew they were at 65% of minutes versus it was 54% last quarter in the second quarter. So you kind of knew that. I think it was really the revenue guide. And so without formally announcing a price increase, they gave you kind of a revenue guide and a margin and a profit guide for next year that just looks really conservative. They're guiding to 12%. They just did 21% ex currency this quarter. And ultimately, we think that number is probably going to be closer to 15 to 17%, depending on the timing of when they put the pricing increase. And then they basically said we can get to that revenue number without a whole lot of advertising next year. And the advertising really kicks in more in the fourth quarter next year, or 26. So, and then you have margins were up 650 basis points or guided to, and they're only guiding for 140 basis points of margin next year. So you really could see where, even where street numbers shake out today, they could still go meaningfully higher.
So you think, the analyst community is always excited about price hikes. Some have thought maybe it was coming ahead in December ahead of those NFL games, but consumers hate them. And at some level, if you don't really need to pull that lever, why risk alienating some of your audience? Or do you think the cash they're throwing off is highly predicated on continuing to do so?
Look, the reason this company has been so successful is they have invested in more content than any other company on the planet right now in the entertainment business. So they need just to keep the flywheel going. And ultimately, their goal was to have like one new show come out a week.
Wow.
Right. And the strike slowed that down. They talked about that last night on the earnings call. And they're just starting to get back to the kind of cadence that they want to be at. So I think once they get to that cadence, the price increase is coming. I'll give you another statistic. 2 years ago, when they raised the price for the standard tier, it was at a 50% or so premium to Disney Plus. Today, it's only a 9% discount, and it's actually less expensive than some of the other other streaming services out there. So there's no question that they deserve a price increase. But to your point, there is churn whenever it happens, and the timing and based on the content cycle is important.